Welcome everybody to today's webinar. I'm Kieran Osborne, the Chief Investment Officer at Mission Wealth, and I'm really excited to be joined by Fran Beyers. Fran is the Head of Capital Markets at Cliffwater and also the Co-Portfolio Manager for the firm's flagship direct lending strategy, the Cliffwater Corporate Lending Fund. She also helps manage the widely used Cliffwater Direct Lending Index. Fran is a true expert on direct lending and a thought leader in the space, and has frequently been cited in the media. As many of you know, Cliffwater is a key investment partner of Mission Wealth's, and their direct lending strategy is a cornerstone of many of our clients' alternative allocations. Cliffwater had been at the forefront of the direct lending asset class for years. Quite frankly, I don't know of a firm that knows more about direct lending than Fran and her team at Cliffwater. So we're very excited for Fran to share her thoughts with you today. It's such an interesting market environment right now, with Fed policy and economic growth front and center of many investors' minds. Direct lending as an asset class has done particularly well, while stocks and bonds have experienced an increase in volatility on the back of concerns around a higher for longer interest rate environment. Direct lending continues to be a high conviction investment of ours, and I'm sure today's discussion will illuminate why. We've received a number of questions ahead of time, which we'll aim to address. So let's dive into it. Fran, how about we start at a high level? Some on this call may be less familiar with direct lending. Can you provide an overview of what direct lending is? How is direct lending different than public credit and bond markets? And can you detail the floating rate nature of the loans, which is an attribute that has really helped direct lending outperform, especially in comparison to the broad bond market, which struggled as the Fed raised interest rates?
Thanks, Kieran. And it's really a pleasure to be here today and to speak to you all on the market. I'm a visual kind of girl, so I'm going to share my screen and have some slides that we can go through to try and give you a better understanding of the market. And after this webinar, Mission will make it available to you all if anybody's interested. So you all can see my screen, hopefully. Kieran, you can see the screen? Okay, you're shaking your head. So I'm just going to move it. There we go, to presentation mode. Okay, so let me give you just a brief overview of what direct lending is. It's actually pretty simple. It's a very large and growing universe of asset managers that are outside the regulated banking system, that are making loans every day directly to companies, either in the US or globally. And in return, they're receiving contractual interest payments, which in turn gets passed on to you, the end investor. So while the media may be portraying this as a newer asset class, or it feels new because we finally have a variety of vehicles that are tailored to everyday investors, giving you access to this asset class, it's really not a new asset class. So the reality is direct lending has been around for a multitude of decades. It's just that the lenders providing these loans are changing and its popularity is growing rapidly. So lending to small, medium, and large-sized businesses, it really used to be dominated by banks and insurance companies for nearly 40, 50 years. These banks underwrote the loans, they held them on their balance sheet, but a variety of regulations over the past 15 years, you may have heard of like Dodd-Frank or leveraged lending guidance. A lot of these regulations have hampered banks' ability to hold these loans. And so large asset managers have basically been stepping in to be the lender of choice to these companies. So what distinguishes a direct loan from a public loan or a public bond? First, the direct lending executions do not have an investment bank as an intermediary. So in the public loan and bond markets, if a company needs a loan or a bond, they would go out, they would hire an investment bank to underwrite the loan for them. But that bank would hold very little of that risk. They would instead distribute that loan in very small pieces across a group or a syndicate of, say, 50 to 100 investors. And then post-close, those investors can either choose to hold those loans or bonds to maturity if they wanted to, or they can exit those loans by selling them in a secondary market. Now, on the flip side, with direct lending, there is no bank involved. The direct lenders are underwriting these loans and diligencing these borrowers themselves, and there is no secondary trading. These loans are held to maturity. There's a couple of other few notable differences between public and private markets. First is the size of the borrowers. So in the public markets, for example, it is typically for large corporate borrowers with around 100 million of EBITDA and up. And for those of you that are unfamiliar with what EBITDA stands for, it means earnings before interest, taxes, depreciation, and amortization. It is basically just a proxy for the cash flow that the company generates. While in the direct lending market, it could be for small borrowers, medium borrowers, large borrowers with EBITDA anywhere from 10 million up to 400 million. So the direct lending market is actually a much bigger investable universe than the public markets. In fact, 90% of companies in the US are in fact private. And if you look at the chart here on the right side of the screen, what you can see is that the size of the direct lending market has been growing very quickly. Today, it's almost comparable in size to the public markets, but at the trajectory it's going, it's expected to surpass $2 trillion within the next 5 years. A couple of other just real key differences. Direct lending deals do have higher pricing on the loans by roughly 100 to 200 basis points more than what you can get in the public markets. This is called an illiquidity premium. Because we can't trade in and out of these loans and they're private, you get a premium for coming into them. And then lastly, direct lending loans have more protections such as covenants and tighter documentation than the public markets do. Although I will caveat, the larger the company, the more the doc does start to converge with the public markets. And then Kieran, you asked the definition of floating rate and first lien. So I'll cover that really fast. Unlike your investment grade or high yield bond portfolios, where bonds are issued at fixed interest rates that are locked in, direct lending is a floating rate asset class. So that means as the Fed raises or lowers rates, the interest rate on those underlying loans of the borrowers will also increase or decrease. So this, what it does is it eliminates duration risk in your portfolio. And this is a big reason you don't see massive swings in the values of these loans versus you would on a bond, because these interest rates regularly reset every 3 months. So a lot of folks view direct lending as a natural interest rate hedge, which is why a lot of investors like having a regular allocation to it in their portfolio as a diversifier. And then the last point I'll make is most direct lending deals are first lien. So what is a first lien loan? It means that you are at the very top of the capital structure of the borrower. It means that direct lenders have a first claim on all the assets and the value of that company should anything go wrong or if the borrower were to stop servicing their debt. So not unlike the mortgage on your house, if you were to stop paying your mortgage, the bank can actually come in and take your house and sell it. It's the same thing here. A first lien lender is first in line to take the entire business over if that borrower does not meet its contractual obligations on the loan.
Thanks, Fran. And that provides a really great overview of the asset class. So I'd like to dive a little bit deeper into a few different aspects of direct lending. But maybe we start with this question. Many loans within the direct lending asset class are what's known as sponsor-backed or private equity-backed loans. Can you explain why that's important?
Yeah. So I would estimate that anywhere between 85 and 90% of the direct lending market involves making loans to sponsor-backed companies, which means that businesses are owned by a private equity shop. And there's a couple of reasons why this is the case, but I'm going to highlight 4 major ones, why this is a huge positive. First, given lenders tend to be very high volume, they're often generalists that work across a variety of sectors. It really helps to work alongside a highly sophisticated private equity firm who has operational expertise. So often these PE platforms have very deep industry expertise across a few verticals. They have operational expertise to help these management teams of the companies basically take their businesses to the next level of growth and development. The second major reason is relationship and accountability. These direct lenders have a roster of tier 1 or top tier sponsor relationships where they know the partners really well. They've worked with them through many cycles. There's a high degree of trust and conviction that the PE firms that are buying these companies not only are experts in these sectors, but are only doing so after they have done deep diligence on the company. That's really important to making good loans. And for direct lenders that are building a large diversified portfolio, we can lean on the sponsors for information flow, for their expertise, and their entrenched relationship with these management teams. The third major reason is PE-backed businesses have meaningful alignment. So private equity shops are writing massive equity checks to buy these businesses. And you can see this on the slide here in the chart on the right-hand side. This is the deal math. It basically shows that when a PE firm goes out and buys a typical company, they're financing over 60% of the purchase price of that company with their own equity. And then they're usually financing maybe 35 to 45% with debt, which is what the direct lenders are providing. So these PE shops, they're really looking to grow these companies over a 3 to 7 year period so that they can make 20 to 25% returns on their equity. So they're looking for very high growth businesses with a lot of white space and earnings potential. That's a positive, right? We want to lend to companies that have a lot of nice growth trajectory. And for them to hit that return hurdle, they basically have to pay back the loan. So there's a lot of comfort we get knowing that this equity is below us. We have a first lien on these assets, and that private equity shop doesn't make their return and can't make their fund a success until that borrower basically exits that loan. The last major reason PE ownership is a huge positive is because of the fact that these private equity firms are the most well-resourced and sophisticated and flush with capital animals that are out there. So this chart here on the left basically shows you annual fundraising for North America private equity buyout shops. They're basically raising anywhere from $250 to $350 billion per year. That's really robust. Not only that, but they can access these capital commitments despite what's going on in the macro. They don't see this liquidity dry up in tougher times. So knowing that you have a parent company there with record levels of dry powder, which today in the PE space is almost $1 trillion, to support those borrowers through a downturn or if an exogenous credit event were to happen, it's just often results in better outcomes. And that's why direct lenders focus on PE-backed deals.
Thanks, Fran. So borrowers, especially larger companies, they do have some choice of where they can borrow from. And more recently, we have seen a trend for larger companies who would previously have borrowed in the public markets, now taking out loans by the direct lending channel. But those direct loans, as you alluded to earlier, do typically come with higher interest payments. So from a borrower's perspective, can you explain to the group here why they would want to choose to go down the road of direct lending versus the public bond market?
Yeah, no problem. So I like this slide a lot. It's like my laundry list of why a borrower chooses one execution over the other. And, both executions are there for a reason, and the market's always going to have these two executions. It's just that direct lending is really gaining a lot of market share. But for starters, to issue in the syndicated market, we'll start on the right-hand side. A borrower, it really requires a minimum level of scale because a syndicated loan, it requires a public rating, and size is really important for post-close trading liquidity. And so historically, there was a clear trend in the market where middle market borrowers or companies with EBITDA below 75 million went to the direct lending market. And then once a borrower hit meaningful scale of 75 to 100 million of EBITDA, they would pivot to getting a rating and hitting the public markets. That's how our markets really functioned for a decade. The clear benefit that a borrower gets going to the public market is obviously cheaper pricing, looser covenants, and looser documentation. Not great for investors, but better for the borrower and the sponsor. And then historically, the public markets had more size and depth. So if you were executing $1 billion plus deal, you had more depth in the syndicated market. But a few market shifts have taken place in the last 3 to 5 years that has now made direct lending very popular, and even borrowers of meaningful scale are still staying direct rather than going syndicated. And the syndicated and high yield bond markets are losing meaningful AUM right now. So the syndicated market can be very volatile. That's what we saw over the last 2 years. The window to tap that market is and to get a great execution is really not always open. So sometimes it can be just as expensive or even more expensive if that happens, or if a syndication just doesn't go as planned, because an investment bank has to flex up the pricing to clear their deal. And you guys may have remembered seeing in the newspapers, Twitter was a deal that the investment banks underwrote. They got stuck with the deal. They couldn't sell it down. There was a lot of that going on over the last 2 years. So in the public markets, yes, the spread can be lower and the borrower still has to pay a lot of extra fees that they don't pay for in direct lending. They have to pay an underwriting fee. They have to pay heavy fees to get the deal rated. And then if that rating doesn't go well, or if it gets downgraded, it can really hurt their cost of financing because then their loan trades down. So the other negative in the syndicated market is there's a lot of hot money investors. So open-end mutual funds, for example. So money can leave that market every day. So there's a lot of technical volatility that can cause loans to trade down. So basically, when times are good, syndicated market's great. It's cheaper, you get a great execution. But when times are or they're challenging, that market's very inconsistent and it really doesn't work for private equity. Now, flipping to the left side of the screen, we can talk about why direct lending is the preference right now. So first, it's the most flexible execution. It can offer much more creative solutions to the borrower. And these lenders can extend capital across the entire capital structure, from first lien down to junior capital. That's very valuable to a sponsor. They also offer a lot more options, like longer tenor revolvers or term loans with delay draw capability, which means that you can lock in that capital. And then when you're doing acquisitions or M&A, you can go back and access that capital 3 months later, 6 months later. You can't do that in the syndicated market. Secondly, direct lenders capital is very sticky. It's very stable. We don't have hot money coming in and out of our market. The buyer base is very dedicated, which means that it's consistently there through time. Borrowers and sponsors want consistency. It's very relationship oriented. So the borrowers and the sponsors know who their lenders are, how they behave in good times and bad. And then the last key piece is it's very easy to work with a small bank group, open up that deal and do add-on acquisitions, do amendments. It's very difficult to do that in the syndicated market. So as PE is really relying on a buy and build strategy, it's making direct lending really the execution of choice. And I don't see it flipping back anytime soon.
That's really interesting. Switching gears a little bit, Fran, I'd like to talk about realized volatility and the valuation methodology for loans within a direct lending portfolio, such as your flagship fund, since loan valuations and volatility are closely linked. The realized volatility on direct lending funds has been relatively low recently, like, for instance, the Cliffwater fund, and especially in comparison to the volatility witnessed on the broad bond market recently. So why is that? And what are the key factors that would make you adjust loan valuations?
Sure. So I graphed this here for you on the slide. It shows 3 different market segments. First, we have the fair value marks on the public loan index, which is in dark blue. This is the Morningstar LSTA index. And then I have direct lending, which would be similar to how our fund would move in the turquoise line. And then the high yield bond market is graphed in the gray line. What you'll find is that through cycles, through tumultuous times, all the asset classes do move up and down in a very similar fashion. They are correlated. It's just that the public loan markets move and the bond markets move with much more force and volatility than the direct lending market does. High yield bonds are the most volatile of the 3 because they have duration risk. So they're mostly moving not only because of sentiment and what's going on in the macro, but because of interest rate changes, which of course has been quite rapid in the last 12 to 18 months. Now, there's a few reasons why the public markets move with more volatility than the private markets. The first is, we talked a little bit about it earlier, technical selling or buying pressure due to these open-end mutual funds. A lot of mutual funds and bonds and loans offer daily liquidity and redemptions. And so forced selling can cause a lot of changes in these prices. Shifts in the sentiment on the economy or specific sectors can cause meaningful volatility. And then rating or sector downgrades or upgrades is another factor because this buyer base moves very similarly and thinks very similarly. So any movement in the markets from sentiment can move this very quickly. Meanwhile, in the direct lending market, we don't have open-end funds. We don't have forced selling. The money raised in our market is long-term. It's locked up. So you don't see trading in a market. So it doesn't react to that. Also, sentiment doesn't really change price in our market because these lenders are buy and hold. They're underwriting and lending with a view of through the cycle performance. So headlines don't move direct lending marks. So valuations on direct lending loans really only change in 2 instances. The first is market-wide dislocations, and the second one is individual borrower stress. So I'll start with market-wide dislocations and give you an example. Say direct lenders are making first lien investments at pricing of SOFR plus 550. That's the market. That goes on for many, many quarters. But then you have an exogenous shock like COVID. And the fear from COVID causes liquidity to dry up or fundraising efforts to stall. Now direct lenders are saying, well, our capital has become much more precious. Everybody is saying, now we're only going to extend those same loans at SOFR plus 650. So we saw a big change in the pricing of the loans on new deals. Well, if the new clearing price on the loan has moved higher, that means all of yesterday's loans are just worth less. So a loan may get marked down from 98 to 95. It doesn't mean the loan is underperforming. It just means that by today's market standards, it's underpriced and hence just worth less. Now, despite that mark maybe moving down to 95, we still feel good about getting repaid at par. It was simply an unrealized loss. And then oftentimes what you'll find is as the market rebounds, that loan will get marked back up 1 to 2 quarters later back to 98. These types of big market movements are pretty rare. So typically quarter to quarter, the marks stay relatively stable. The bigger factor that drives material changes to evaluation of a loan is the credit performance of the borrower. So when a borrower is in distress and the cash flows of the loan are at risk, the loan will get marked down. This doesn't happen on the entire portfolio. It only happens on the individual names that are struggling, which is like the tail of the portfolio. What you hope is that your manager has built a big diversified portfolio so that any individual loan, when impaired, doesn't move the value of your overall fund materially. It's also important to note that direct lenders that manage vehicles like interval funds or BDCs, they're typically hiring third-party valuations to come in and provide the valuations on these loans. So you do have an independent outside perspective marking these loans that's getting the financial information of the borrowers and providing those suggestions. On CCLFX, we mark 100% of the fund, both quarterly using third-party agents, and we also mark the fund daily based on what's going on in that dark blue line, the Morningstar LSTA index. So we're actually capturing both the market movements that might happen in the broader market, and we're capturing the underlying borrower financial performance movements in the fund.
Awesome. Extending that prior question, can you speak to downside risks for direct lending? What does a really bad year look like? And can you walk us through a catastrophic downside event? What would a 2008 scenario look like for direct lending returns?
We should do this webinar before drinks if we're talking about catastrophic downturn events or what they look like, but happy to, because we had one. So on this slide, for those of you that don't know, we have an index. It's called the Cliffwater Direct Lending Index. I actually manage that along with Steve Nesbitt, who's our CEO, who created the index about 10 years ago almost. But anyway, the Great Financial Crisis in 2008 was without a doubt the most extreme downturn that the market faced. And we're actually very fortunate to have the data on how direct lending performed during that time. So happy to share what that looks like. So looking to this chart here on the left, this shows realized losses by year within the CDLI. Realized losses can be two things. It can either be forced asset sales at a loss, or it can be loans that have gone bad from a credit standpoint and principal was lost. If we look at realized losses through a 20-year period here, the average annualized realized loss rate is around 100 basis points a year, which is shown in the blue line. So we tell people you're coming into direct lending on average 100 basis points per year in principal, is the average of the market. Now, during the GFC, we saw realized losses peak at 7%, which is really high, right? But what is fascinating is that when you look at the chart on the right, this shows you the total return of direct lending versus leveraged loans and high yield bonds, and it includes those losses. And what you'll notice is in 2008, direct lending really didn't do that bad compared to every other asset class. Equities were down 40% in 2008. Public loans were down over 30%, and high yield bonds were down 26%. So direct lending only down 7% is actually an outperformer relative to many other asset classes. And that was the only negative return year. So it took a 3 sigma catastrophic downturn to bring direct lending into a negative return. Now, why? Well, this is because of the outsized yield and risk premium that the assets generate contractually that was still coming into the portfolio at the time, which muted some of those losses on part of the book that defaulted. Now, I would argue that this draconian outcome we saw after the GFC is highly unlikely to be repeated because the asset class now is far bigger and far better. And I'll highlight why. So back in 2008, 50% of direct lenders were doing junior capital. They were doing a lot of mezz and second lien and equity, which is far riskier and has a higher risk of loss. Back in 2008, they had a higher exposure to like very small, lower middle market credits. A lot of them didn't survive coming out of the GFC. Portfolios were smaller. They were more concentrated by number of credits. Many of the platforms back then had very unreliable investor bases, like leverage. If you remember, hedge funds were like really popular back then. So we saw a lot of forced asset sales because the hedge funds went under. And then to top it all off, large banks were going under. So there was no liquidity in the system. So it was like nothing more could have gone wrong. Today, the space is much higher quality. So direct lenders are bigger. They're better capitalized today. 80% of the direct lending universe is now first lien assets. Some lenders are exclusively first lien, like CTLFX is 95% first lien. They are now lending, we're lending to bigger and higher quality companies in more defensive sectors. You're not seeing direct lenders lending to like energy or heavy cyclical companies like they were, back in 2008. There's a lot more liquidity in the system. These lenders have ample access to financing. Their capital structures are much more flexible. So we're not anticipating a GFC-like downturn, nor do we expect losses to be this grave, given how improved and high quality the lenders are now. The last major point I want to make is this asset class does have, you tend to see losses pick up in tougher macro environments, right? As you look to the chart on the left. So you can see, again, the long-term average is 1% per year, but during tougher times, those losses do pick up, like COVID, like the 2016 energy downturn. While during more benign times, like 2021 to 2022, those losses are minimal. The chart on the right shows you through that nearly 20-year period, despite a wide range of outcome and losses, we rarely had a negative year in direct lending. Outside of 2008, every year in direct lending was in that mid to high single-digit return range, despite the fact that losses are happening in most years. This is a normal occurrence to have some level of losses. So this is why we often refer to direct lending as an all-weather asset class. Meanwhile, direct lending returns, they tend to outpace public loan and bond markets in most years. And we highlighted in blue here on the right, which of these asset classes had the highest return. You could see direct lending has the highest return in, 75% of the years.
So Fran, speaking to potential concerns, if interest rates stay elevated, which we do anticipate they will, do you think we'll see an uptick in default rates as companies may struggle to keep pace with increased interest costs? And if so, what does that look like?
Yeah, it's a really good question. And I know there's been a lot of Wall Street Journal and news articles about, direct lending and how it's going to perform. Of course, it's a very in vogue asset class and it gets a lot of clicks. So they're going to write stories on it. But I'll give you some color on how borrowers are withstanding the current rate environment. The good news is that default forecasts from 12 to 18 months ago have come way down. Okay, so when base rates first started beginning to climb at the outset, a lot of debt strategists were coming out and they're like, oh my God, direct lending is not going to survive if base rates keep going up. We're going to see default rates go to 10%, which would have put us back at the GFC era. This is what people were saying 18 months ago. As you can see by the chart here on the left, this shows you non-accruals. That's basically a loan that is defaulted on its principal and interest. This is within our index, okay? This is updated through June. We'll have the September numbers in a couple of weeks, but non-accrual rates are nowhere near 10% right now. As a matter of fact, they're not even yet at the long-term historical average, back 20 years, which is 2.1%. So now the strategists have come back and they've said, well, maybe defaults peak around 5% at the worst of it. I don't have a crystal ball, so I couldn't tell you, exactly where defaults are going to be, but my view is I would expect the non-accrual rate to go back to the long-term average and live in that 2 to 3% area if rates stay where they are, and if the economy continues to just slowly kind of come back to reality. For defaults to go back to 5% level, we'd probably need to see a material exogenous shock to the economy, like a COVID. You can kind of see COVID, it went to 3.5%. It also didn't even go to 5% during COVID. Of course, the Fed came in and saved the day, but those types of events are very hard to predict. Market-wide, what I'll say is we are seeing non-accruals rise. It's very modest each quarter. It's not happening rapidly. It's far slower and controlled than what we saw during the GFC or COVID, because this weakening the economy is happening at a much slower pace than in previous recessions. And the economy is actually still producing positive growth. It's more that we're seeing a normalization to pre-COVID levels. Meanwhile, when lenders and sponsors do have time and they have money, unlike COVID, we didn't have either, but right now they have both. They have time to put solutions in place to help these borrowers weather. And that's kind of what sets direct lending apart from the public markets. We have the tools and we have small enough bank groups to get amendments in place to help these borrowers should they need support. One of the tools we can utilize is highlighted in the chart on the right. This shows something called PIK income. What is PIK income? It's basically the part of the interest expense a borrower pays that is non-cash. It stands for payment in kind. And so, you know, if a borrower pays S plus 650, usually you get that 12% yield in cash. But if we're going through a tougher cycle, you can allow the borrower to maybe pick part of the loan. So if they're struggling with their interest expense and their cash flow, we can provide some level of interest rate burden by saying, okay, maybe 2 or 3% of the loan will be PIK. It just adds to the principal balance of the loan, and then you get that back when the loan gets repaid. Now, when you look to the chart here on the right that shows this PIK trend, it's actually been pretty steady the past few quarters. It's not showing a huge jump, right? You would think, oh, interest rates are high, we should be picking more, but it's really not. It's kind of been flat. So it's going to show you that the borrowers are withstanding the base rate environment. I do think over the next 2 to 4 quarters, we see lenders rely on this tool a little bit more if the economy softens. But now a lot of strategists are coming out and saying, hey, maybe we even have rate cuts next year. We really don't know. Kieran, I'll rely on you to tell me where you think rates are going. But as of right now, this picture has not shown a meaningful deterioration based on what the media is outlining.
Awesome. Yeah, we're definitely in the camp of higher for longer interest rates. You know, I like this question because it gives an insight into the underlying economy and fundamentals of businesses. You know, within your flagship fund, you know, you allocate to well over 3,000 underlying loans. Those loans are made to businesses in every industry and sector of the economy. So your portfolio data can really provide a good pulse on what's going on in the broad economy. What are you seeing in terms of underlying fundamentals? Are top line revenues and bottom line earnings continuing to grow? Or should we be concerned about slowing growth, as some headlines suggest?
Yeah, it's a really good question, and we get it a lot. Again, because we really, you know, it's a tough environment to predict where things are going. So what I tried to do is at least pull some data for you on how the underlying EBITDA growth and revenue growth of the companies are looking. So the chart here on the left shows you year over year EBITDA growth in the Morningstar LSTA index, which is basically the public loan market. While the chart on the right shows year over year revenue and EBITDA growth in the Golub Altman Index, which represents Golub Capital's direct lending portfolio. You'll notice both charts are still showing positive borrower financial growth. The LSTA index on the left is certainly showing that growth is slowing down quicker. This is because sector really matters. So the chart on the left is a grouping of borrowers across a large swath of sectors. It's probably more reflective of the overall economy. Whereas the Golub index on the right, as you can see, is concentrated across a few sectors that drives the bulk of their portfolio. I would argue, you know, Golub's sector focus on technology and healthcare is also pretty emblematic of the direct lending market, which also tends to focus on those sectors and much, you know, very defensive sectors. What you'll note here is that the growth rates on the right are much higher than the ones on the left because direct lending borrowers, again, tend to grow faster. And they have these M&A buy and build strategies that helps them get their EBITDA moving up very quickly, as opposed to the deals on the left, which are bigger companies, more established and more mature. Now, while the data is helpful, I'll say that let me give you my point of view of just areas where we are seeing softness in research reports and financial statements and MD&A and lender calls. I'll go through where we're seeing some softness. First is in consumer goods and services, because we had this massive COVID bump between 2020 and 2021. That is now normalizing as consumers are spending less, consumer debt is going up, and so we're starting to see them become more careful about what they're buying. Sectors like logistics or trucking, which involves the movement of goods and services, is also showing a slowing. Logistics companies are often a great barometer of recessions, roughly 6 months before they happen, because they see the weaker volumes and the weaker rates. We were hearing earlier in March, some of the logistics companies were saying, we see recessionary pressures coming. That was 6 months ago. The economy's still chugging along 6 months later, but they are seeing some pressures. Distributors were living with a pullback for many quarters, as many of their end clients were going through a destocking trend post-COVID. That's actually starting to normalize. We think it's actually reversing and going back to positive, which is a good sign. The other sector facing pressure is healthcare, mostly because of higher wages and challenge in finding labor. The dental office is having a hard time getting people work at the front desk. Okay, they're making not a lot of money, and they make more money selling stuff online and Instagram, I guess. Nothing to do with demand pressure. We always need healthcare services, regardless of what's going on in the economy. It's just been a challenge for some of these healthcare companies to find labor post-COVID. But that is starting to improve as we are seeing more folks eventually go back to work. Now, on the flip side, there's sectors that have been chugging along quite nicely. We continue to see very strong growth and stability in insurance, financial services, which we actually have a meaningful share in our CCLFX portfolio of those two sectors. Obviously, the Golub Index is showing tech borrowers are still the fastest growing, and they're doing really well. Aerospace and defense, industrials, they're all performing at a very low default rate. They're seeing very good performance. In fact, industrial companies are doing better today than they were 12 months ago, because they had very large backlogs. They had COVID supply chain disruptions, record steel prices, record shipping costs and energy costs. Like, that dynamic has actually subsided, so they're seeing margin expansion. So overall, I'd say it's a very unique environment where management teams are signaling in the financials that they're seeing slowing growth, they're seeing some modest recessionary pressures, but no recession has made itself apparent yet. I do think winning revenue is becoming harder than it was 2 years ago. Some borrowers are behind on budgets, but others are doing really well and are continuing to raise prices. So I think all these mixed reviews is a big reason why there's a lot of uncertainty and volatility. Even the Fed truly doesn't know where the economy is headed because it's been so inconsistent. So what does that mean for direct lenders? Our job is to recognize the best quality companies, to lend to those companies that we feel really good about their value prop, their market position, and their staying power. Make sure the structures make sense. And that's how we've been focusing our time in this environment, and just making sure we're putting the most defensive companies in the portfolio.
Yeah, it's really interesting insights there, Fran. I mean, from our standpoint, we are seeing, some slowing in the labor market and the unemployment rate starting to tick back up again, which I think is what the Fed wants, to help rein in inflation and cool the economy a little bit. It's certainly, economic growth has certainly come in well ahead of expectations, certainly at the beginning of this year relative to where we are today. But, I would say that the expectations of a no landing or minimal landing outcome have certainly risen over time. Okay, last question for you, Fran. What's your outlook for the direct lending asset class? Despite potential increases in default rates and loss rates, do you consider this to be a favorable environment to be investing within direct lending?
It's another great question. So I guess that my biggest takeaway here, and the point I'd like to make, is that, yes, we do expect defaults and losses are going to pick up. I think that's a good assumption, but it's going to happen in the tail of the portfolio, while the rest of your portfolio is actually producing the highest yield on record right now. And you can see this in the chart on the left. This basically shows the all-in yield on first lien direct lending loans across the market. Now, to have first lien risk paying you a 12% yield versus only paying you 6 to 8% the prior 10 years, that's extremely attractive. So yes, rates have gone up and everybody's worried, but guess who benefits? The end investor in direct lending, because all that income is getting passed on to you. In fact, it's actually making other asset classes look less compelling right now, because these types of returns are almost junior capital or equity-like returns by historical standards, and it's first lien risk. Yes, we expect some stress in parts of the market due to the macro and to the rates, but the majority of your portfolio is going to perform fine because these direct lenders lent to defensive sectors. All that income's getting passed on to you. So in the chart on the right, I tried to highlight some high-level math of just what does a typical levered direct lending portfolio return over the last 10 years. And again, this is hypothetical, when base rates were near zero. So a typical direct lending return was in that mid to high single-digit area there. And what you'll see is we assumed a very low level of losses here. This is a 1-to-1 levered portfolio, 1% losses, which was the average through time. But with where rates are even today, even if we modeled 2.5 times the amount of losses, we're not experiencing that type of loss rate right now, but let's say in the next 5 years, losses pick up by 2.5 times. And I even forecasted a 4.5% long-term base rate as opposed to we're at 5.3 today. You're still earning a higher return than you were the prior 10 years. So if we don't even have these loss rates pick up to this level, you're probably earning a low double-digit yield today on most direct lending products. And then if you combine that with all the other qualitative factors we highlighted earlier on bigger and better companies, well-capitalized sponsors and lenders that are underwriting through the cycle, the fact that deals are leaving the public markets and coming to our markets, it does make the case that direct lending is still highly compelling, particularly if you're worried about drawdown risk in other asset classes and you're worried about duration risk. And, this is more of an all-weather asset class that you're lending through the cycle, long-term, compounded annual returns. I think it still has a very good case to make a nice allocation in anyone's portfolio.
Yeah, awesome. I think that provides a great deal of insight. And hey, thank you, Fran, for everything you've shared today. I know there's a lot of great information. And thanks everybody on today's call.